The Reserve Bank of Australia officially lowered interest rates this week for the first time in many years. Since November 2023, the cash rate has been sitting at 4.35%. Now it's down 0.25% to 4.1%. So what does this mean for homeowners and the federal government, especially with an election expected to be called any minute now? Earlier this week, I spoke to Dr. Daniel Kiely from the Bankwest Curtin Economics Centre in Perth. Well, first, Dr. Kiely, thank you very much for joining me today. First question, were you surprised that the RBA decided to cut interest rates? Because there was a lot of speculation about what the RBA would or wouldn't do, but it turns out they had decided to cut the rate by 0.25%. It's the first time we've had such an interest rate cut in several years.
Yeah, that's right, Daniel. And look, I think a lot of economists were expecting a rate cut in the nature of what we saw, the 25 basis points or 0.25%. To be honest, I was a bit on the fence. I wouldn't have been surprised if they had held the interest rate as it was. We still see underlying inflation sitting at 3.2%, which is outside the RBA's target band of between 2 and 3%. Of course, inflation or CPI is at 2.4%, which is positive. But as I said, that trimmed or underlying inflation remains outside of that 2 to 3% band. And that trimmed mean it excludes some very volatile items, which could be causing that the CPI to sit at 2.4%. So again, a lot of people look more so at that underlying inflation rate, which again, as I said, is at 3.2% above the target inflation rate.
Now, the RBA had said in their statement as soon as the rate cut was announced that they are happy with how inflation has been declining, but they have warned of other factors as well, such as economic growth is still relatively weak. They're also concerned about the tightness of the labour market, as well as external factors, including international events. What is your take on what the RBA had said?
Yeah, look, there was certainly a word of caution there in terms of expectations around future rate cuts. They were very firm in their wording around not to expect future rate cuts, because again, it is very much a watch and wait and see in terms of what future data comes out with around inflation and CPI. The next quarterly CPI release comes towards the end of April, and there'll be a lot of eyes watching that one. As you say, the labour market is remaining very strong. Unemployment rates remain low, and there's a tightness in the labour market. So we're still seeing, increases in employment. We are seeing a shortage of workers across many sectors of the economy. And there's a worry there from the RBA, and they've signalled this around the fear that this tight labour market could lead to further wage pressures, which in turn could lead to further inflationary pressures. So again, they're very much saying, the interest rate that now exists is still a restrictive one, and there's no guarantee of further rate cuts in the near future.
You mentioned that we had these inflationary pressures. I know that the RBA was, of course, very concerned for quite a while about inflation being too high. What are some of the driving forces for that inflation? I know that there was concerns over things like government spending as being a contributing factor.
Yeah, look, there's a lot of factors at play here. Obviously, on the back of the COVID-19 pandemic and the supply chain issues that emerged as a result of that, border closures, factories impacted in the likes of China and other areas, we saw that supply chain disruption very much impacting inflationary pressures. So there was very much a supply side element to it. We are seeing the demand side also strong, where again, with a strong labour market, you are seeing activity remaining there despite the high inflation rates. But many households are finding it hard. There are cost of living pressures. As you say, government spending, that's actually been a really important part of our economic growth of late. It's been an important factor to keep us out of negative territory in terms of our growth across the national economy. But consumer spending, business investment has remained reasonably weak. And therefore, again, with the drop in interest rates, the RBA will be hoping that we'll see some pickup in terms of consumer confidence, business confidence, and perhaps again see those as further drivers of economic growth across the economy.
I know also that international factors can be very much out of our control. We currently, of course, have the war in Ukraine continuing to have a major impact on so many of Australia's imports and exports, as well as our business and trading partners. We also have the uncertainties to a degree about what the United States is doing regarding tariffs and the rhetoric from US President Donald Trump, and then you throw in potential trade wars involving China and all these other factors that can combine to create a lot of uncertainty in the world market. Do you think that could also have a potential effect on the Australian economy and possibly on our cost of living and interest rates?
Look, absolutely. Again, I think we're all watching with a very careful eye, particularly the trade wars and the impact that they will have. There may be some direct impacts through direct tariffs that are placed on the Australian economy and exports from Australia, but also the indirect effect. If there's a slowdown in the Chinese economy because of tariffs placed on Chinese exports, to what extent will that impact the Australian economy? To what extent will it impact iron ore prices, for example, will be something that will be very closely watched. And again, the RBA signaled to this as well in their announcement today. They're very careful to say that there's a lot of uncertainties within our economy, these trade tariffs being one of those, and the impact that they will have. It will take some time yet to see how that fully plays out and takes effect across the economy. But again, it's a reason why the RBA are cautious here. It's a very slight decrease in the overall cash rate. It is some relief to households, but in the context of the 13 increases in the cash rate that we've seen over the last number of years, it's a very slight relief to households, and that's not going to dramatically change people's circumstances.
And it's interesting, when I looked at how interest rates had been since the early 90s, of course, we had the rather infamous 17% and going back to the 1970s, 20s and 24% and all that. And I remember that many years ago, interest rates of about 6 or 5% was considered low. But now, taking into the factors of our increased cost of living, the COVID-19 pandemic, an interest rate of 4.35% was quite pressing on a lot of households. And it does show how different the world has been over the past few decades, considering that what used to be considered a relatively low interest rate is now considered quite high. Do you agree with that?
Yeah, look, I think that's absolutely a fair point. In historical context, yes, cash rate is relatively low. But again, you've got to keep in mind the context, as you say there, that, before we saw these rate rises, the cash rate was effectively almost 0%. Okay. So, the impact and the shock it had on households, those increases, was quite substantial. And it takes households time to adjust their expenditure patterns and change behavior to be able to meet those additional mortgage repayments then and change consumer behavior, which is why we also saw, for example, savings rates go down significantly on the back of the COVID-19 pandemic, where again, during COVID, people actually saved quite a lot because they weren't able to spend as much with border closures and lockdowns. So saving rates increased, but we saw savings rates go down quite substantially in the last couple of years. So again, households have been feeling the pinch, have been dipping into their savings in order to maintain living standards. I guess back to your point as well, central bank policy and monetary policy has changed, particularly where central banks have started to target inflation and set target rates of between 2 and 3%. And that's been quite successful. and in turn, you've seen less of this massive variations in interest rates as well, because of the success of some of that monetary policy.
Now, the Treasurer, Jim Chalmers, said today that the worst is now behind us, and he was going for this soft landing, which many treasurers and governments always hope that they would have. As you would know, Ireland, of course, was usually tried to aim for that soft landing, but then they fell through the floor and I think down to the core of the earth in the 2000s under Taoiseach Brian Cowan. And at the moment, Jim Chalmers seems very confident that things are going to go quite well. Do you think that the worst is now behind us?
Certainly in terms of the high inflation rates that we've seen, on the back of the COVID-19 pandemic, I think it's unlikely that we'll return to anything like that in the near future. Michelle Bullock, the governor of the RBA, was very, very clear to say it's very hard to predict the future, and particularly when you go beyond 6 to 12 months, it's very hard to see what will happen, and there's a lot of uncertainties that can happen. Certainly, the trade wars, the global uncertainties there, as you say, the crisis in Ukraine, the continued crisis there, Middle East uncertainties, these will all be weighing on governments' minds. They are creating uncertainties in markets. And, again, it's very hard to predict the future, but I do think that the RBA has done a good job in containing inflation and bringing it back down to what are reasonable levels. We've been very fortunate here in Australia that the labour market has remained strong despite the high inflation rates, despite the increase in interest rates. Labour market has remained strong. But we do need to shift away somewhat from a reliance on public expenditure to maintain economic growth. And the RBA again signaled that they want to see household consumption, business investment, that private sector starting to drive more of the economic growth across the economy, and that's really important.
And how do you think Tuesday's decision will impact the upcoming federal election campaign? There was that speculation that if rates had been put on hold or even risen for whatever reason, Prime Minister Anthony Albanese would delay the election till May. But now that we've had this cut, there is that analysis that he might decide to visit the Governor-General within a matter of weeks, and we could go to the polls around mid-April. What kind of impact do you think this could have?
Look, again, obviously the RBA is an independent entity and would have made this decision solely on the basis of the economics of it and what made good economic sense given the data that they had at hand. Of course, as you say, this may lead to an earlier election because, again, from a political perspective, some will play this as, the success of government in playing a role to bring inflation back in to within its target rate, whilst, again, the labour market has remained strong. There are some success stories there that could be played out in the political economy situation. And as you say, as a result, you could see an earlier election being called there. The Treasurer did as well mention in his speech today about the budget, and it'll be interesting to see what emerges in that, particularly in a pre-election sense.
Doctor, thank you so much for your time.
No problem. Thank you.
Dr. Daniel Kiely from the Bankwest Curtin Economics Centre in WA there.